Welcome to the Deep Dive. Today, we're really cutting through the complexity of global markets, especially now, right after the U.S. Labor Day holiday. That's often kind of a pivot point for market momentum, isn't it? So our mission is to explore, the intricate dance of key global currency pairs, gauge the pulse of U.S. equity markets, and unpack those major macroeconomic indicators shaping decisions right now. Think of this as your essential briefing. We want to give you clarity, equip you with insights to understand not just what's happening, but, well, the deeper why behind it all.
Exactly. And we've sifted through a lot of financial news, economic calendars, market data to really distill the critical insights, trying to make it a structured, actionable summary. The goal really is to help you navigate all the noise, spot the crucial trends, and ultimately feel more confident in your financial outlook. There's this fascinating tension in the air this week, I think. Strong expectations for central banks, sure, but also some surprisingly resilient economic data. And then you layer on the shifting geopolitical currents. We're going to explore how those forces are, pulling markets in different directions.
Okay, let's jump straight into that tension then. Central banks, they're always the starting point. Their decisions ripple everywhere. So what are the latest expectations around the Fed's next moves, especially after some recent commentary we've heard?
Yeah, what's really front and center for the Fed is this anticipation of a rate cut. It's strong. Our analysis of market data, including the CME FedWatch tool, it indicates a pretty substantial 85% probability of a 25 basis point cut. That's for the upcoming FOMC meeting on September 17, 2025. And this really follows that notably dovish interest rate cutting shift we heard from Chair Powell back at Jackson Hole.
85%. Wow. Okay, that is a very strong signal. But given that conviction for a cut, how does it square with the latest U.S. economic data? The numbers we just saw come in. Are we seeing signs that really, truly support such a move?
Well, that's where it gets interesting. It's a bit of a mixed picture. So today, September 2nd, we got several U.S. indicators. The S&P Global Manufacturing PMI for August, surprisingly robust, came in at 53.3. That's significantly stronger than the 49.8 forecast, so clearly indicating expansion in manufacturing. Construction spending for July also contracted less than people thought, minus 0.1% versus a minus 0.4% forecast, so better there too.
Okay, so some strength.
But on the flip side, the ISM Manufacturing PMI, it was better than its 48.0 forecast, came in at 49.0, but it's still below 50, right, which signifies contraction. And what's particularly notable, maybe even a counter-signal to aggressive rate cuts, is that ISM manufacturing prices for August rose to 65.1. That's higher than the 64.8 forecast. So it suggests these inflationary pressures, especially on the input side for manufacturers, they're not entirely going away.
Right. So the market's pricing in cuts, but the data, especially those price numbers, hint inflation might be stickier. That creates a real dilemma, doesn't it? How are other major central banks, like, say, the European Central Bank or the Bank of Japan, handling their own situations?
Yeah, looking beyond the U.S., the ECB, the European Central Bank, they're holding their main rate at 2.15% right now. The next meeting is coming up, September 11th, 2025. For the Eurozone, inflation is key. Germany's CPI, their consumer price index, showed inflation at 2.1% in August, just a touch over the ECB's 2% target. Economists are a bit divided, honestly. Some projections see maybe one more ECB cut by December, but market sentiment seems less convinced that more cuts are definitely coming this year.
Okay. And Japan?
Over in Asia, the Bank of Japan, the BOJ, they maintain a significantly lower rate, just 0.50%. Actually, the BOJ deputy governor is scheduled to speak today, September 2nd. And recent comments from him have suggested, no immediate urgency for a rate hike, so that signals they're likely continuing their accommodative policy, which really stands in contrast to what we're seeing or expecting from the Fed and maybe the ECB. This policy divergence, it's a really key factor driving currency movements globally.
That leads us perfectly into the currency markets then. Given these different central bank approaches, what are we seeing in key pairs? Let's start with USD/JPY. What's happening there?
Sure. Our analysis shows USD/JPY has been trading within a pretty well-defined range, specifically between 146.20 and 148.51. It was around 148.3 earlier today, September 2nd, about 4 a.m. Eastern Time. The short-term outlook, it suggests that a sustained move above that 148.51 level, that could signal the bullish trend is resuming, possibly targeting 150.90 or maybe even 151.22. And that 151.22 level, just for context, that's the 61.8% Fibonacci retracement. It's a key technical level. Traders watch for potential reversals or strong resistance. On the other hand, a break below 145.84 could lead to a short-term bearish move, maybe down towards 139.26.
Okay, those are very specific technical levels. Fundamentally, though, what's creating that push and pull? Why is it stuck in that range for USD/JPY?
Yeah, the fundamentals really highlight that central bank divergence we just talked about. It's a classic push-pull. On one side, you've got the expectations for Fed rate cuts here in the U.S. If the Fed cuts, generally that weakens the dollar. But on the other side, the Bank of Japan's commitment to low rates keeps the yen weaker. Yeah. So it's really a battle between dollar weakening Fed expectations and yen weakening BOJ policy. It's interesting, actually, order book data from Oanda earlier today, around 6:00 a.m. Eastern, it showed significant sell interest clustered up in the 148.000 to 149.00 range, while buy orders were concentrated down around 145.00 to 146 per 0.000. So that clearly shows where traders are seeing the key resistance and support right now.
Right. And this broader dollar trend, especially the expected weakness from potential Fed cuts, maybe other factors too. What does that mean for Euro USD?
Well, the USD pair is currently hovering around the 1.16 handle. The price is about 1.1593 as of September 1st, reflecting a slight dip that day. But the bigger story, the overarching narrative through the first half of 2025, has really been dollar weakness. The dollar index, the DXY, which measures the dollar against a basket of other major currencies, it's down, 10.7% year to date. And it fell 1.9% in August alone, down to 97.6939. A lot of news commentary consistently points to the dollar being in a bear market, suggesting this depreciation might continue. Factors like U.S. debt accumulation, maybe perceived unconventional policy approaches, they're often cited as reasons. So this broadly bearish dollar outlook, it does provide a supportive backdrop for USD, even if the ECB itself isn't, rushing into aggressive cuts.
Okay, let's pivot now. U.S. equity markets, we're past Labor Day. How are the main indices, S&P 500, NASDAQ, Dow performing? What should we be watching as we head deeper into September?
Right. Looking at the close on August 31st, 2025, the S&P 500 finished at 6,469 points. That was a solid 1.9% gain for August, and an impressive 9.8% increase year to date. It even briefly poked above 6,500 before pulling back just a bit. The NASDAQ saw a minor daily decline, minus 0.22% that day, but it's still up a strong 11.1% year to date. And the Dow finished down about 0.25% for the day, with a 3.73% gain year to date. Now, futures for these indices today, September 2nd, they're indicating a slightly lower open after the holiday. Suggests maybe a cautious start to the week.
Yeah, robust year-to-date performance, definitely. But that caution in the futures, the little pullback from 6,500 on the S&P, it signals maybe some underlying tension. So how are investors really feeling right now? Is it all optimism, or is there more anxiety under the surface?
That's a great question. Gets to market psychology. The CNN Fear and Greed Index, which blends 7 different indicators like momentum and volatility, it's currently signaling greed. So that implies a fair degree of market exuberance, suggests investors are feeling pretty confident overall. However, if you look at a contrasting measure, the AAII Sentiment Survey, that's the American Association of Individual Investors, it reveals bearish sentiment way down at minus 40%. Now, what's fascinating here, historically, such low bearish readings from individual investors have often been a contrarian buy signal. The S&P 500 has actually risen in 90% of cases in the 6 months following readings like that, with an average gain of like 15.1%. So you have this really intriguing contradiction, institutional metrics pointing to greed, while individual investors are feeling quite pessimistic, which ironically some might see as a positive sign for the market going forward.
That is a truly interesting dichotomy, isn't it? So are specific sectors or maybe just a few big stocks driving these overall market trends? Or is it more widespread?
Well, while some big tech names like NVIDIA down 3.32% recently and Tesla down 3.50% saw declines, the broader market actually showed pretty healthy underlying strength. Small cap stocks, for example, represented by the Russell 2000 index, they gained a significant 7% in August. And maybe more importantly, 67.13% of S&P 500 stocks are currently trading above their 200-day moving average. That's a strong sign of healthy market breadth. It means the gains aren't just concentrated in a handful of mega-cap names. And this broad support, plus the strong corporate earnings we saw for Q2, where 80% of companies beat expectations, that continues to provide a pretty solid foundation for equities overall.
Okay, beyond the pure economics and central banks, we can't ignore the geopolitics and policy factors. They seem to be playing a bigger role lately. What significant headwinds or maybe tailwinds are we seeing from the global political stage right now?
Yeah, you're right. What's really injecting uncertainty, I think, are policy decisions from the U.S. administration, particularly around tariffs. For example, the U.S. recently escalated tariffs on Indian exports, raising them to 50% from an already existing 25%. Stated reason was India's continued purchases of Russian crude oil. And then, adding another layer of complexity, a U.S. federal court ruled that most of the previous administration's tariffs, the ones imposed on various global regions, were actually illegal. So that creates considerable ambiguity for trade policy going forward, doesn't it? It leaves businesses kind of grappling with future planning. Definitely a headwind for global trade stability.
And these actions aren't just happening in isolation, are they? These U.S. moves seem to be prompting responses, maybe shifting alliances elsewhere. What's the global reaction looking like?
Absolutely. It definitely raises questions about, evolving global alignments. We're seeing various news commentary highlighting leaders like China's Xi Jinping, Russia's Vladimir Putin, India's Narendra Modi. They've been holding meetings recently, actively strengthening their economic and political ties. These gatherings are widely seen as forming a kind of unified stance against what they perceive as U.S. unilateralism and protectionist trade policies. China, for instance, has notably pledged grants and loans to its SKO partners, the Shanghai Cooperation Organization, reinforcing those alliances. Brazil's also taking action. Their president convened a virtual BRICS meeting specifically to discuss the impact of these U.S. tariffs. So yeah, it indicates a pretty coordinated global response aimed at mitigating what they see as American protectionism.
Okay, stepping back to the domestic picture for a second, what about the impact of these policy discussions, these broader political dynamics, on institutions like the Fed itself? We've heard some rumblings there.
Yes. Concerns about the Federal Reserve's independence and potential political interference, they are indeed impacting market sentiment. You can feel it. Reports about proposed dismissals of Fed governors by the U.S. administration, they definitely contribute to a broader sense of market uncertainty. And this political dynamic has actually been cited as one factor contributing to reduced demand for U.S. Treasuries, especially the longer-term bonds, which in turn puts upward pressure on yields. So for investors, it adds another layer of complexity. Not just the economic data, but also the stability and the perceived independence of key financial institutions.
Right. So as you, our listener, process all this complex information, this resilient economy, the signals from central banks, these big geopolitical shifts, the evolving trade picture, what are the key takeaways? How do you navigate this?
I think what we've observed is a market that, while fundamentally strong in many areas thanks to those corporate earnings, the prospect of Fed cuts, it's simultaneously wrestling with significant geopolitical tensions, plus rapidly evolving trade policies and these internal political dynamics impacting crucial institutions like the Fed. It's this really intricate web of factors, and it demands careful consideration. You can't just look at one piece. And remember, historically, September is often a month of increased volatility for stocks. So maintaining a flexible, vigilant approach to your investment strategy seems particularly important right now. Don't let one headline dictate your whole view. It's about seeing the whole ecosystem.
Okay, and to help you stay ahead, what are the absolutely critical events on the economic calendar we should be watching in the coming days? What should you keep an eye on?
Looking ahead this week, a critical event for the U.S. is definitely the jobs data. That will heavily influence the Fed's September decision. Everyone will be watching those numbers very closely. Also, President Trump is scheduled to speak at 2 p.m. Eastern Time today, September 2nd. That could always introduce some new market dynamics. You never know. For the Eurozone, keep an eye on the CPI print, that's Consumer Price Index, at 10 a.m. London time, which is 5 a.m. Eastern today. That's important for European inflation watchers. And over in Japan, the 10-year JGB auction, Japanese government bond auction, combined with that BOJ deputy governor speech we mentioned, that'll be a key test of investor appetite and the BOJ's ongoing policy stance.
Yeah, that interplay between the domestic economic strength, the central bank expectations, and this increasingly complex global geopolitical landscape, it creates a truly fascinating tension. The big question, maybe, as we close this deep dive is, how much can a strong economy really absorb? How much political and trade uncertainty can it handle before market sentiment fundamentally shifts? It's certainly something for us to continue exploring, and maybe something for you to ponder as you look at your own strategies in the weeks ahead.